Welcome to this explainer. Today we're going to logically deconstruct what is essentially the ultimate X-ray of a business, the statement of financial position. Whether you're looking at a massive global corporation or just that local corner store down the street, the principles we're about to cover, they're exactly the same. We're going to break down the language of accounting to see exactly how the health of an enterprise is recorded, measured, and communicated. All right, let's dive right in by asking the core question that every investor, student, and small business owner absolutely must answer eventually. How do you prove a business is actually healthy? I mean, it's one thing to say a company is making money, right? But to truly understand its financial standing, its stability, and its future potential, well, we've got to look beneath the surface. We need a standardized way to weigh what the business actually owns against what it owes.
Here's our roadmap for today. We'll start with the accounting equation, move on to organizing assets by liquidity, look at liabilities and the ticking clock, assemble the actual statement, and finally, we'll wrap up with the power of notes.
Section 1. The accounting equation. The ultimate balancing act. So the absolutely crucial point here is that everything a company owns, its assets, must be funded by something else. Assets don't just magically appear out of thin air, right? They're either funded by borrowed money, which we call liabilities, or they're funded by the owner's own capital and retained earnings, which is the owner's equity. That equation literally must always balance. Think about it. If you buy a delivery truck for your business, well, you either took out a loan to get it or you used your own hard cash. This quote really hits the nail on the head. It highlights that the complex document we're building toward is actually just a frozen snapshot of this exact equation at one specific moment in time. When you look at a statement of financial position, you're really just looking at a detailed, expanded list of assets on one side, perfectly balancing against the liabilities and owner's equity on the other side, specifically frozen on one single date. Moving to Section 2, assets, specifically organizing them by liquidity or their proximity to cash. Now, what's really fascinating here is how the simple concept of time so cleanly separates your short-term energy from your long-term infrastructure. We divide our assets into two very clear categories. You've got current assets, which are expected to be converted to cash or consumed within 12 months, and non-current assets, which are held for long-term use in the business operations. Let's look at current assets. These are basically the highly liquid muscles of the business, meticulously listed in descending order of their proximity to hard cash. Cash is literally always listed first, just because it's the most liquid thing you have. Then you have things like marketable securities, accounts receivable, money customers currently owe you, and your merchandise inventory. And hey, even prepaid expenses, like supplies you bought for future use, are considered current assets simply because they provide short-term benefits to the business. On the flip side, your non-current assets are your heavy anchors. We're talking tangible structures and long-term investments held to produce value over many, many years, definitely not for a quick sale. This includes your land, your buildings, heavy machinery. It even includes intangible assets like patents and trademarks, plus long-term investments meant to sit and grow for years. Let's be real, you can't exactly pay tomorrow's electric bill by selling a single brick of your factory. And that is exactly why these are kept totally separate from your current liquid assets. On to Section 3. Liabilities, the ticking clock of tracking debts and obligations. Just like we did with assets, we separate liabilities by the ticking clock of that exact same 12-month rule to see what's urgently due right now versus what's spaced out over time. This separation is absolutely vital for assessing risk. Think about it. If a company has massive debts, but they aren't due for 20 years, well, that's a very different stress level than if those exact same debts are due next week.
So, current liabilities. These are the immediate obligations keeping the lights on, the ones demanding short-term cash flow to settle within the current operating cycle. This includes your accounts payable, which is money you owe suppliers for goods you bought on credit. It also includes accrued expenses, things like unpaid salaries or taxes. Interestingly enough, this also includes unearned revenues. Now, I know the word revenue sounds like a great thing, but if a customer pays you in advance, before you actually deliver the goods or services, that's a liability. You owe them the work, and until you do it, that advance payment is a very real obligation resting on your shoulders.
Then we have non-current liabilities. Think of these kind of like a 30-year home mortgage. Sure, they're massive obligations, but they are safely structured to be paid off far into the future, well beyond 1 year. Long-term bank loans and bonds payable sit right in this category. They are absolutely essential for funding those big non-current assets we talked about earlier, like buying a piece of land or building a brand new facility. All right, section 4, the statement assembled. Let's put these building blocks together.
And here is the final X-ray. It's a beautiful, organized list clearly separating Renren Merchandising's liquid assets against its pressing debts. As you'll see, the current assets are clustered at the top left, the non-current assets are right below them, and the corresponding current and non-current liabilities are neatly stacked on the right side, sitting just above the owner's equity. It really is a perfect visual representation of the entire equation we've been discussing. By visualizing this balance, we can instantly tell a really compelling story about Renren's health. They are highly liquid. Looking at the breakdown of their 1.51 million pesos in total assets, we see 810,000 are current and 700,000 are non-current. What this tells us is they're holding more value in short-term flexibility, like cash and inventory, than they are in rigid long-term assets, like property and equipment. And for a merchandising business, that is generally exactly what you want to see.
So the most crucial point here is that when you look at the absolute bottom line, the fundamental accounting equation is flawlessly balanced. Renren's total assets equal exactly 1.5 million pesos. And if you take their total liabilities of 830,000 pesos and add that to the owner's capital of 680,000 pesos, you land exactly on 1.5 million pesos. The equation holds absolutely true. It's perfectly balanced.
Finally, Section 5, the power of notes. Think of this as the detective's magnifying glass. Now, the supporting notes are where you really uncover the crucial backstory and the specific realities of how an asset or liability is truly performing in the real world. On the main statement, you might just see a single line item that says, property, plant, and equipment, $700,000. But what exactly does that mean? Is it all just one empty dirt lot, or is it an entire fleet of delivery trucks? The supporting notes are exactly what tell us the whole story. For example, look at note 8 here from our source material. Instead of just blindly trusting that 700,000 peso total, this table clearly proves the exact makeup of those assets. We see land at 500,000, a building that initially cost 500,000, and various pieces of equipment. But look really closely at that middle column. You'll see the business actively factors in the wear and tear on its buildings and equipment to give it truly honest net value. And this note introduces a super important reality check, a contra asset. In this specific case, it's accumulated depreciation. It ensures the business doesn't overstate its value by acknowledging that physical tools like buildings and equipment, well, they degrade over time. You literally subtract this expired cost from the original purchase price to get the real current carrying value of the asset. It's basically a built-in reality check for our financial X-ray. As we wrap up this explainer, I really want you to apply these building blocks to your own life. What financial story would your personal X-ray reveal? If you listed out your personal current assets against your immediate current liabilities right now, would you be liquid and flexible or stretched a little thin? Understanding this foundational accounting equation isn't just for massive corporations. It's literally the exact same math that governs our own financial health. Thanks so much for joining me today. And remember, keep questioning the numbers behind the story.